Hey yo. With the market starting to dip and valuations still sky high, many may be wondering if there's any sense in investing at the moment. Indexes seem iffy with a lot of bloated stocks trading way above their earnings, and stock picking seems just as tricky as Korea's blue chips are the ones that led this bull run all year. So, what are we to do? Well, that's what we're talking about today. You're watching Sekider, and this is what we're watching for the week of January 18th to the 24th. Now, before we continue, we'd like to ask that you do us a favor, just scroll down real quick, hit the like and subscribe buttons, and keep up with the content that we'll be releasing over the course of the year. Also, this is just a reminder that this channel is meant for educational purposes only and is not meant to replace any financial or legal advice from a paid professional. We're just here trying to introduce retail investors to our local stock market. Now, let's get to it. To address the question at hand, I'd like to refer to the late Jack Bogle, who started the Vanguard Group and has probably helped way more regular people strengthen their finances than any other investment group in the history of our species. Specifically, I'd like to refer to a speech that he gave back in 1997 when valuations were just as high as they are today. Let's listen in.
On that note, then, let me close with 5 simple principles, a few ideas of what you might want to think about, principles of investing that may help you. First, invest you must. The biggest risk is the long-term risk of not putting your money to work at a generous return, not the short-term, but nonetheless real risk of price volatility. Even though stocks seem very high, consider what I said in my book, a little plug there. Never think you know more than the market does. You're apt to be wrong if you do. Second, give yourself all the time you can. At the extremes, if you're in the 20s, begin to invest in stocks even if you've only got a little bit. If you're in the 60s, invest more in bonds and less in stocks. But always remember that compound interest is a miracle and time is your friend. Third, have rational expectations about future returns and be mentally prepared for market declines. Always remember, in good times and bad times alike, this too shall pass away. I spend a full page in my book on that sage piece of wisdom. If this too shall indeed pass away, and your emotions can kill you, you should keep them out of your investment program because impulse is your foe. Fourth, rely on simplicity. Simplicity above all. There are too many witch doctors in this business with too many. Basic investing is simple. A sensible asset allocation to stocks, bonds, and reserves, a middle-of-the-road selection of diversified funds, a careful balancing of risks and returns, and lest we forget costs, which can kill long-run returns too. Don't disregard low-cost index funds. That's my only plug. Warren Buffett just happens to agree, I'm buttressed by his support, on the importance of cost and on the value of indexing, a nice third-party endorsement, if you will. And fifth and last, when you've followed all of these 4 rules, as I said, and I've meant 1,000 times, if not 10,000 times, no matter what happens, stay the course. Good luck in investing in these interesting times. Thank you.
Now, Jack Bogle is really well known for the saying, invest you must. And so today we're going to try to figure out how to find value in a bloated market. Now, that being said, for many of us looking to invest in good companies with a margin of safety, the priority to look for is good value for the stock as well as a high quality of underlying company that will, in the long run, continue to grow over the length of our holding. When searching for such companies, there are a few very basic numbers to look for that usually represent both good value and a good company. First, as we've stated heavily and many times over the history of our channel, is the PE ratio. I don't think I need to go over this anymore, but historical ratios have sat between 10 to 20 times earnings, so anything within that range can be considered standard value, with numbers closer to 10 being better value. Simple, straightforward, but also a little bit overly simplistic. So we usually have to look at a few other numbers to figure out whether or not the company is good. Now, another thing to look for when buying a company is a dividend. This is to ensure that the company is not only creating value for its shareholders through its internal processes, but that it's actually paying back some of it to the shareholders. High yields are good, but they're only good as long as they're sustainable, and that brings us to our next point. Good companies are always and never not sustainable. Thus, something to look at is their dividend payout ratio. If a company is paying out all or more of their profits as dividends, then it means that they're putting little to no profit back into the company. The only other ways of financing growth outside of reinvesting profits is either to take on debt or take on more liabilities, or to sell new shares. Taking on debt is not ideal if you have any other options, and selling new shares dilutes existing shareholders, and that's also not great for the current shareholder. Thus, a high dividend yield with a low payout ratio is golden, more so if the PE ratio is also in our preferred range. Finally, you have growth. We can try to predict growth all we want, and there are many people whose jobs it is to do so. But for people like us, there are a few numbers that are readily available that can tell us whether or not a company has grown in recent years. One of the things to look for is a year-on-year increase on cash from operations. This can usually be found in the cash flow section of a company's profile, and it simply refers to the amount of money that the company has made from either their service or their product. Another thing to look for is an increase in revenue, as cash flows are specific to the exact amount of cash that's come in or left the company, but revenues also consider intangible assets as well. Finally, to be sure that the shareholders are getting a fair return as the company grows, another thing you'd like to see is a growing EPS. Of course, these numbers can be finicky, and things like stock buybacks can fabricate EPS growth, so be sure to look into their yearly reports to get a better idea of what's happening in the company. Finally, the balance sheet. No public companies have zero liabilities, as public equity itself is considered a liability. Still, it's important to see that a company's liabilities are covered by their assets, or, in the case of companies making a turnaround, that the disparity between the two is on the right track, meaning decreasing liabilities and increasing assets. Now, this may all seem like a lot to satisfy, and that's kind of the point. The more specific the criteria, the more you're able to protect yourself in the long run. And with the market as overvalued as it is, it behooves you to protect yourself as much as possible. So today we're going to look at two companies that meet most of these expectations and may be worth further consideration, both of them being NICE D&B and Seegene. Starting with the first company. NICE D&B is an arm of the information services family of companies called NICE and deals with corporate credit. Now, if you've ever worked in a public school or public office or a mid to large size corporate office that didn't have its own internal employee tracking system, you're likely to have encountered the NICE program. Used by organizations both public and private, NICE Information Services is an institution within Korea's institutions, and the other stocks within the family also deserve some attention as well, but what we're talking about today is NICE D&B, which focuses on providing credit reporting services on the country's many businesses. The back end of the name, D&B, refers to the US company Dun & Bradstreet, who are an internationally recognized institution focused on the use of data and analytics in a global capacity. They aim to use their vast troves of data to develop high quality and internationally standardized business profiles for companies who apply to be a part of their database. Now, I realize that's just a bunch of words that probably don't mean anything to you, so I'm going to go ahead and demonstrate the importance of D&B through the use of a very important asset that belongs to them called the DUNS number. In short, the DUNS number is a 9-digit code that's given to a company once they apply for it, and it remains the same as long as the company continues to operate. It's an ID address that tracks the company and provides detailed reports about their financial stability to potential lenders, investors, or partners. DUNS stands for Data Universal Numbering System, and it's a system that is relied upon by companies and financial institutions worldwide to gain reliable and standardized information on other companies that they may aim to do business with. Now, if you want to learn more, there's a link in the description box that leads to the D&B explainer on the DUNS number. But suffice to say, although it's not a mandatory inclusion in the establishment of a company, having a DUNS number is very important for companies that look to develop an official record of their financial credibility on an international scale. NICE D&B is the Korean wing that conducts credit investigations and updates data to the D&B system for companies in our home markets. Now, as NICE D&B is a company that's primarily interested in business credit ratings, one would expect that they themselves have a well-managed company with good-looking books. A little look under the hood shows this to be true. So let's start with basic value. The most recent price-to-earnings ratio available is from September of last year, in which they clocked in at 13.33 times earnings. The stock price has been fairly constant since then, so it is probably quite safe to say that the number is representative of where we stand now, if not a little bit lower, assuming that it has continued to grow at the same rate as it has in the past few years. Now, how can we identify the company's growth? Well, until we get an official report from last year's results, we can base our assumptions off historical data. Since 2015, NICE D&B's earnings per share, book value per share, revenue, and incoming cash flow from operations have all grown consistently. What's more is that their total cost of revenue, or the amount spent to generate earnings, has grown at a much slower rate than their revenues, reflecting a high quality of return on capital expended, or ROCE. Now let's look at the dividend. Although NICE D&B's dividend is on the low end in the 2% range, it should encourage investors to see that the dividend yield, amount, and payout ratios have steadily and consistently increased over the past few years. Furthermore, their payout ratio is still in the low to mid 20 to 30% range, which may seem low to some, but it's likely good for shareholders as the return on capital expended, which means the money that they didn't pay out as a dividend but actually used to improve the company, has actually been consistently improving the company. And this suggests that their growth is not a fluke and it will continue to be progressive in the future. Now to price. The stock has been hovering between 10.5 and 9.7k for the last few months, and trading volume remains relatively low when compared to other stocks in the market, so NICE D&B may be a good company to consider if you search for value and aim to hold it for the long term. Now, let's take a look at Seegene. Seegene is a biomed company that has really seen a boon in sales as their COVID-19 tests have become increasingly more coveted over the past year. Thus, their return on equity is expected to be in the 124% range, having shot up from 30k last January to roughly 180k so far this month. While this is down from its heights of near 300k in the middle of last year, it's still a massive gain that can be credited to being prepared while also being in the right industry at the right time. Now, favorable, unfavorable circumstances aside, it's once again important to look at the company's history leading up to their COVID boom. Simply looking at their yearly numbers, it really seems like COVID simply sped up the inevitable success for a company that was already steadily increasing its revenue, earnings per share, and book value per share. Their liabilities have never gotten close to a dangerous level when compared to their total assets, and they've steadily scaled up their operations while paying off debt, while never ending up in a negative cash flow position. This suggests that the company's success in an industry fighting to gain market share as the pandemic rages on should not be a surprise. Just for consistency, let's check out the boomer stats, aka the PE ratio. At the time of their last reporting, Q3 last year, the PE multiple was at a clear 14.68 times earnings. Naver's most recent stat pegs them at less than 10 times earnings, as its stock has steadily declined from its peak and settled around the 180k mark. If Seegene is able to capitalize on this windfall and use the profits to upscale their R&D as well as their production, now could be a good time to get into the company. You would of course have to weigh in the impacts of COVID on their earnings and take a deeper look at their investor materials to get a better idea of the ins and outs of the company. And there you have it. 2 potential value stocks to look at while the market is chilling at all-time highs. Remember what Bogle said. In the short term, the stock market is a casino. In the long run, it's a machine for compounding interest and returns. NICE D&B and Seegene may be 2 companies that can do that compounding consistently at good value. Just make sure to take a deeper look into the companies whose homepages I'll link in the description box below. Alright, this actually ended up being a lot longer than I expected, so take it easy fam. Got another video coming later this week, but until then, make sure you do your research and practice doing valuations. The more you practice, the better you'll do. And the better you do, the more you'll be able to develop your own investment style. Take it easy.